Taiwan central bank hikes unexpectedly. The Swiss National Bank also surprises, but with the first rate cut of the majors. The Bank of England holds. Strong Australian jobs growth has hit hopes for an early rate cut from the RBA, and New Zealand is in recession. That's coming up in 5 Things in 5 minutes. And then, in our bonus deep dive interview, ANZ Chief Economist for Greater China Raymond Yeung says the 7 key risks facing China's economy this year all start with the letter D for dragon. He looks at whether D for deflation will seep out from China into the rest of the world.
The reality is that we are seeing the Chinese consumer goods getting cheaper and cheaper because they might not be able to export to the rest of the world, but at the same time, the domestic consumer will enjoy, this lower price by manufacturers locally.
But first, in 5 and 5 with ANZ, Taiwan Central Bank, the CBC, hiked its main policy rate by 12.5 basis points to 2% overnight, which was a surprise, says ANZ economist Bansi Madhavani.
The recent upside surprise on inflation, along with the fact that CBC also wants to rein in inflation expectations, both these factors came together and became a perfect combination for the CBC to act. We also think that, there are proposed power tariff hike in Taiwan, and that would be something that the CBC is quite cognizant of and keeping them cautious about the inflation outlook. What's important to note is that we think the CBC will be on a wait and watch mode from here on. The risk for another hike seems to be much smaller because we do expect inflation to trend down over the next few months.
The other surprise was the Swiss National Bank cutting its main rate by 25 basis points to 1.5%, making it the first major central bank to ease.
The question now is which turns out to be the second major central bank to start cutting rates.
Number 2. Well, the next one won't be the Bank of England. It held its main rate overnight. Bansi says it's still on track, though, to cut in August. Meanwhile, global stock markets just keep rallying, and the US dollar remains strong versus the yen at over 151.5, and other currencies, including the Aussie dollar, which is at 65.70 US cents at 5 a.m. Sydney-Melbourne time, and the Kiwi at 60.41. The S&P 500 is up around 0.5%, and the US 2-year Treasury yield up 1 basis point. Bansi says traders seem reassured. Rate cuts are still coming from the Fed, even after signs inflation is stickier and higher than expected.
What stands out is that financial markets saw the FOMC meeting broadly as a validation that the recent upside surprises that we've seen in inflation are probably a bump in the path to reaching 2%. The market is currently priced in for around 80% chance for a June 25 basis point rate cut. Now, we continue to think that July remains the most likely period when the Fed will start cutting rates, because it's only by July meeting that the Fed will have and will be able to guide on inflation progress and labor market progress through the first half and talk about outlook for the second half.
Number 3, Australian employment growth surged in February with 116,500 new jobs, compared to a consensus forecast for 30,000. That drove the unemployment rate down from 4.1% to 3.7%. ANZ senior economist Blair Chapman says the RBA will have taken notice.
Potentially the labour market's actually a bit stronger than we and the RBA were thinking, and that means that our call for November is looking more spot on, with today's numbers suggesting the risk of them cutting earlier has actually been pushed back a bit.
Number 4, New Zealand is officially in recession, or technical recession at least. Quarterly GDP fell 0.1% in the December quarter after a 0.3% fall in September. Weakness in retail and wholesale trade and in goods-producing industries led the fall. But ANZ senior economist Miles Workman says it wasn't all one way.
Momentum is certainly slowing, but relative to expectations, there were components of the data that were actually a little bit stronger than expected. So in particular, we saw services growth come in a little bit stronger than we thought, and likewise with private consumption. That came in at positive 0.5% quarter on quarter, where we were expecting a 0.6% contraction, and the Reserve Bank was expecting a 0.5% contraction.
Number 5. Miles says that while the Reserve Bank shouldn't be too worried about that, the big picture story is that there is still plenty of sticky domestic inflation.
The Reserve Bank is ultimately trying to put enough pressure on households so they tighten their belts in order to take pressure off CPI inflation. And all else equal, the Q1 GDP data, while certainly a little bit weaker at the headline level than their expectation, does suggest that maybe households aren't reining in their spending quite as much as the Reserve Bank were forecasting.
Miles Workman there. Now, in today's bonus deep dive interview, ANZ Greater China Chief Economist Raymond Yeung looks at the 7 Ds in the Year of the Dragon.
We have recently published a report and go through all the economic challenges facing China in the Year of the Dragon. The dragon itself is that all these economic jargon, and these jargons include deflation, developers, debts, decoupling, demographics, decarbonization, and dollar China. These 7 Ds represent the economic challenges facing China in 2024. Coincidentally, or incidentally, or maybe accidentally, all the economic challenges all start with the letter D. For example, deflation, which has been the biggest challenge that, in our point of view, facing the Chinese economy over the next 5 years and maybe even 10 years down the road. And because we are worried that the nominal GDP growth is actually shrinking more in terms of the growth rate, more than the real rate that everybody is looking at 4.2% or 5% growth, by the Chinese government. And our forecast is 4.2% real growth, but actually the nominal GDP growth is even lower at 3.8% in year 2024.
So let's focus on deflation here. I'm interested in whether this is seeping out into the rest of the world.
I have recently been asked by many clients that whether China is exporting deflation to the rest of the world. From the data, of course, that we know that both manufacturers and even the service provider domestically cutting their output price and selling price. To some extent, the price of consumer goods produced from China is more cheaper. But at the same time, we also have to know that this decrease in output price by manufacturers, which is tradable, is also a result from decoupling. So to some extent that we see the overcapacity that leads to the downward price pressure for Chinese producer. But at the same time, the rest of the world is seeing this inflation because they are cutting the import from Chinese export as well. So it is hard to say the causal relationship between the Chinese deflation and the inflation in the rest of the world, because if the deflation is also an outcome of the decoupling, and then we are basically seeing two sides of the same coin, which is the inflation in other parts of the world may be partially at least a result from the decoupling that result in the deflation in China. So they all happen at the same time. But anyway, that the reality is that we are seeing the Chinese consumer goods is getting cheaper and cheaper because they might not be able to export to the rest of the world, but at the same time, the domestic consumer will enjoy, this lower price by manufacturers locally. But now, obviously, that's also at the same time we see some job and employment pressure to workers and wage growth also trending down. So we're seeing this deflation pressure is real and also will also be a phenomenon that lasts for several years, I believe. For services price, obviously it's not tradable. So it's not really an exporting story, and it's hard to say that China exporting this deflation to the rest of the world. But overall, China is a price taker in the broadly some global commodities such as oil price, but China also has some influence in global commodity prices. In the case of like iron ore or coal, if the Chinese economy is slowing, the downturn will definitely affect the global commodity price.
Raymond Yeung there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, March the 22nd. Catch you next week, where we'll find out what's happening with Australian inflation, New Zealand business confidence, and US GDP. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.